While it was easy to flip the lights off on the global economy, we're certainly finding it's not so easy to flip those light switches back on.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Hello, podcast heads. Welcome back to the Phil Bach Podcast. It is a warm Sunday afternoon in Michigan, and I am joined by Amanda Agati, calling in from Philadelphia. Amanda will soon be taking over as the Chief Investment Officer of PNC Financial Services and is going to give us a macro view of the markets. She's going to tell us what is happening in the fixed income markets that seems to be leading the Fed, equities, and everything else. And she's going to explain what the repo market is and why it matters. So, Amanda, thank you for joining the show.
Thank you so much for having me. I'm delighted to be here.
So first off, when we started talking about recording a podcast, you were the chief strategist of PNC. I know you're still the chief strategist, but it was just announced that you're going to be promoted to chief investment officer in the near future. Congratulations on the promotion. What was that announcement like? Has it changed anything about your day-to-day?
Well, yes, I'm so excited. This is just a very recent development. Really excited about the opportunity to help really guide and craft and mold the investment offering for the asset management group for PNC. My current role is a little bit different from what the near future state role will be. So as chief investment strategist, I currently lead the team that's responsible for developing all of the strategic and tactical asset allocation recommendations. We're also responsible for developing the house views around market outlook, investment outlook, really across the multi-asset class universe. So public equities, public fixed income, and then all the different variations of alternatives. And we publish thought leadership on a highly recurring basis. So weekly, monthly, quarterly, and ad hoc, depending whatever this crazy market throws at us. So that's really my primary oversight as strategist. In the new role, it's going to be really exciting because it's a bit broader. And so what ends up in my purview as CIO is not only the strategy function, but also a responsible investing offering, portfolio construction and management, holistic multi-asset class portfolio solutions, our manager due diligence team, our portfolio analytics group and data infrastructure, trading, really the entire investment offering for PNC's asset management business will roll up to me. And so it is definitely a departure, but I'm really excited to see how this business evolves and how things grow over these next few years. It's a really interesting time in the industry right now, and I think we have a lot of really interesting strategic growth drivers and initiatives ahead of us. So it's going to be fun.
It is an interesting time. So congratulations on that. And there's been so much chatter about how the Fed is backstopping the repo market liquidity. I mean, this goes back even before COVID hit, right? When it really started at the end of 2019, as far as I understand it. So let's start from a really high level. What is the repo market and where does the repo market fit in the entire landscape of the economy?
Well, let me just start by saying at a very high level, in normal kind of pre-pandemic or non-pandemic times, if you will, as an investment strategist and as someone who's guiding multi-asset class, portfolio construction and portfolio solutions, we really wouldn't be paying all that much attention to repo. It's very, very short-term oriented, very short duration. And at the end of the day, it's really much more of a plumbing instrument in the fixed income market rather than an asset class that we would be focused on in terms of an investable opportunity set. And so in normal times, there isn't much to talk about as it relates to repo, or at least there really shouldn't be that much to talk about. You really shouldn't even notice it too much, again, because it's in the background. It's the plumbing of the fixed income markets. And then, of course, as you alluded to in September of 2019, it was sort of like, well, Houston, we have a problem, because basically overnight, as a function of a confluence of factors, we saw these really significant spikes in repo rates which led to short-term funding markets kind of seizing up. That's not the scenario that we find ourselves in today. It's almost the opposite of that. But I think the key message and why we continue to really fixate on repo and really watch it very closely is that it's really very much a reflection of the view that we are not out of the woods yet. Yes, we've come a long way since the depths of the pandemic. Don't get me wrong. I don't want this to be a bearish view at all, but we're definitely not out of the woods yet. We still have this bridge to cross, this bridge to gap, if you will, until we get the economy fully reopened. And so it's really important to shorten up our line of sight and get an understanding of what's happening in the very short run to gauge the success or progress or failure, if you will, around reopening the global economy. I mean, if I step back and just think about this for a minute, the markets and economies around the world have absolutely wrestled with pandemics over the eons. The idea of a pandemic is not necessarily novel. What is novel is that we shut down the global economy and to some degree the financial system in response to a pandemic. And so while it was easy to flip the lights off on the global economy, we're certainly finding it's not so easy to flip those light switches back on. And so even when you look at the economy, we've shortened up our line of sight, kind of taking a departure from some of the usual suspects in terms of industrial production, monthly retail sales, GDP growth. These things are much longer cycle than I think can really give us insight into the path forward. And so while we're shortening up our line of sight, looking at economic indicators to gauge the path of reopening, we're doing the same thing in the fixed income market side, looking at much more short duration instruments than what we might otherwise to really get a sense of, is there a canary in the coal mine, good or bad, in terms of this path forward. And so for us, that's really why we've been spending a lot of time taking a look at repo. And of course, ton of volatility in interest rates across the yield curve spectrum, for sure in repo as well. And so I think it's kind of an important topic that we wrestle with here together today.
Well, certainly. And certainly when there's so much right now, so much analysis that is based on the idea that there are zero interest rates, right? So you have this whole TINA idea. There is no alternative, TINA, where you have to, make different investments, which is, of course, the intention of having, zero interest rates to keep people invested, to keep the markets humming. But when you say that the repo markets have seized up, right? What does that mean exactly?
Well, so I think the seizing up of the repo market is really what happened in September of 2019, and certainly at the beginning of the pandemic in the spring of last year. And it's really this liquidity drought, this idea that there's just not enough short-term funding to keep the system operating. So this is the very opposite and different scenario from where we find ourselves in today. That's the good news. The bad news is it's still not necessarily acting like we would normally expect it to. Ton of liquidity in this system very much awash in liquidity as a function of what the Fed and others are doing from a stimulative program perspective and a QE program perspective. But I think what's sort of interesting is that we've seen the entire front end of the yield curve basically shift lower all the way out to 2 years. Overnight repo has come way down. The 6-month average yield for overnight repo had been trading somewhere in the neighborhood of about 10 basis points. So effectively near zero, right? 10 basis is not anything to write home about. But then in late January, we started to see pockets of time, and this has continued into kind of present, where we've seen repo trade at negative yields. It's actually gone as low as negative 10 basis points in various pockets of time since we started 2021. And it really hadn't behaved like that since about May of last year, when a lot of the Fed programs started to come on with a vengeance. And frankly, a lot of the signaling effect from the Fed had started to work its way through the system. So we've seen the short end collapse all the way down to effectively zero, even into negative territory. But I think what's interesting is that the Fed has absolutely not employed NIRP, negative interest rate policies. It's supposed to be ZIRP, right? But the market is effectively taking it there. And I think that's what's kind of notable. It's also very reminiscent of when we saw the Fed funds futures curve flash negative a few times last year. The policy stance may be one thing, but the market has a mind of its own. And so we're definitely seeing an increase in volatility even around the policy rate. And even though the stance continues to be, we're not even thinking about changing the stance on rates or certainly in terms of QE. What I think is notable, though, is that there's really this kind of proverbial arm wrestling match that's happening here between Powell and Yellen. So Fed versus Treasury. About a month ago, the Treasury announced that it was going to need to cut T-bill issuance by a fairly sizable amount, $400 billion in Q1, $600 billion in Q2. And it's really a function of funding status and cash reserves. And so this is a little bit of a technicality on the part of the Treasury. They're effectively expecting to be in somewhat of an overfunded position relative to the new stimulus programs that are starting to go into effect now. That 1.9 trillion, of course, that the Biden administration has been supportive of. And so there's a little bit of a technicality happening here, but we think that that is actually the primary driver at the moment of what is dragging down yields so dramatically at the front end of the curve. And as you might expect, if they're going to cut T-bill issuance that significantly, pretty sharp, pretty concentrated reduction in a very, very short period of time would no doubt push yields at zero or under zero, given how close we already are. And so there's this idea of a lot of demand, too much capital chasing too little collateral, effectively a shortage of T-bills already. And then you have the signaling effect from the Treasury. And so it's kind of creating this vicious or virtuous cycle, however you want to call it, in bringing the short end of the curve lower. I think also there's so much to unpack in this story here. It's just not getting the attention that I think it deserves. You know, the Treasury doesn't have the authority to issue T-bills at negative yields. This is just really the market taking it there, right? This is that signaling effect. And so at the end of the day, this is much more of a technical issue rather than any policy change that we might expect on the horizon. Of course, the market, and we can talk about this too, we've seen this dramatic and rapid steepening of the yield curve, market taking, longer term rates, 10-year and beyond, up rather significantly. So we have opposing forces and really significant pressure here on the yield curve in the short run. I'm not necessarily convinced that what's happening here is necessarily a function of an acceleration in growth expectations. I think there's a lot more to the story here. And so maybe just to kind of quickly wrap this up, I think it's notable and somewhat concerning, although I don't think that we're necessarily in a position of seeing fixed income markets seize up here. But it is notable that even in a recent interview that the Wall Street Journal did with Powell a few weeks ago, he was very dismissive of any underlying or technical issues in the plumbing of fixed income markets. So he's basically ignoring all the key points that I'm sharing with you on this topic today. And so it's just very reminiscent to us of when the Fed was caught flat-footed back in September of 2019. Repo rates spiked pretty dramatically. And it took a while to get things to calm down, a while meaning a few days to a week or so, but that's a lot of time. That's eons in repo market land. And it was really a function of a confluence of forces, just not enough dollars ultimately in circulation to keep the plumbing working. So again, we're not in that place. We're kind of in the polar opposite place, but I think it's really notable given how frequently and recently rates have been dipping into negative territory. So for us, it's not a signal of major signs of stress or some kind of imminent collapse in the financial system. Not at all. Again, not a full-on bearish story here. I think it's just very much reflective of this hashtag not out of the woods yet, right? This gravitational pull on interest rates, given that we're still sitting basically at zero from a policy rate stance. And so these are not normal times. And I think it just warrants a lot more focus on these short-term funding markets until we can get this economy more fully reopened.
Is it possible for the market to lead the Fed or even force the Fed to raise rates? And how would that happen?
I think it certainly is possible. I don't think that that's likely to happen here. I mean, we certainly, as I said, I've seen this rapid rising in the yield curve, steepening of the yield curve. Markets absolutely been driving rates a ton lately. We're sitting at 160 plus basis points on the 10-year, effectively the highest level of the pandemic. But we've seen a lot of volatility around that number as well. And I think at some point here in the not too distant future, we think that that's going to slow pretty dramatically. Not that we're going to see rates fall back to pandemic lows, not at all, but we think this rapidly rising rate scenario is going to slow down, a little bit of wind coming out of the sails potentially there. But what we think is really happening at the intermediate and longer end of the curve is a couple of things. So it's really the bond market kind of freaking out, and that's a technical term, freaking out that we're going to see this big stimulus package come into effect, 1.9 trillion, which is effectively on the horizon here. That's what we're going to get in terms of stimulus. And then the administration is going to turn right around and try to do another stimulus package, this time in the form of infrastructure of the same magnitude or larger. And our opinion on this is, there is certainly plenty of need for infrastructure spending. It has been the case for several of the prior administrations. It continues to be the case. However, we think it's really tough to get done, even with the composition of Congress. And so while the 1.9 trillion can effectively get done that we're seeing now through budget reconciliation, and they do, in theory, have another shot at it from a budget reconciliation stance, we don't think they're going to get that infrastructure package done without bringing tax hikes back into the equation. And for whatever reason, it doesn't seem as if tax increases are a part of the market narrative right now. So we really think the minute that starts to come back into the narrative, it's going to put the brakes on a lot of things. It's going to put the brakes on the timing for an infrastructure package. It's going to put the brakes on the steepening of the yield curve. It's going to put the brakes on expectations for an acceleration in growth. Not that it's going to derail the recovery, but it certainly can potentially slow it down. It has important implications for earnings growth. There's a lot of variables that kind of rest on this. And so while the market absolutely can take rates higher from here, we think there's a number of other exogenous forces here that are going to slow it down. And so net, that was a long-winded way of saying we don't think that the market is in a position to force the Fed's hand here, because other things are going to come into the equation and slow it down first.
When you try to project out what the market is going to do these days, you have to see something no one else is seeing. You have to, something that isn't obviously priced in already. I know that you use all sorts of alternative data sources. What are some of the interesting data points that you look at that are, a little bit less known, a little bit less referred to? And what are those data points telling you about where the economy is?
Well, so this goes back to what I was saying earlier about kind of getting creative about shortening up our line of sight and tracking some different indicators to get a sense of the path forward. And so in pre-COVID times, I would have never in a million years thought that I'd be looking at things like open table restaurant reservations, weekly retail sales data, like anything that happens in weekly increments pre-COVID would have been way too noisy. There's not enough information typically in these really short-term oriented indicators to get a sense of the path forward. But just given kind of where we are in terms of unprecedented nature of still trying to get this economy reopened, it is helpful to see this incremental progress week after week. And so weekly retail sales have a lot more interesting information than monthly or longer cycled indicators. We're also looking at things like public transit data. There's an app called Move It that, as a function of the pandemic, started releasing public transit data for major cities across the U.S. We're looking at weekly airline passenger volumes. And so no matter what indicator you look at, we've made a ton of progress from the depths of the pandemic and the recession from last year. But we're still coming back to this idea of hashtag not out of the woods yet. They're down 30, 40, 50, even 70%, depending on what indicator you look at. And I think there's just this real massive divergence between Main Street and Wall Street. Wall Street continues to flirt with or hit new highs. And yet Main Street is still very much not out of the woods yet. Still a lot of challenges in getting the underlying economy reopened. And so the consumer may very well be consuming to a degree, but is still very much living in a stay-at-home world. And I think that has really important implications for the near-term path forward. It shouldn't be surprising, given that 70% of U.S. GDP is in states that are under some form of economic restriction and lockdown. Again, we're moving in the right direction, right? We're easing restrictions in many parts of the country, but we still have a long way to go. And I think it's just a notable disconnect between how far and how fast this market has rallied and how far and how fast, or lack thereof, in the case of both, the underlying fundamentals have improved. The other thing that we've been paying a lot of attention to recently is more consumer sentiment and business sentiment oriented indicators. How are consumers and how are small businesses feeling about the pace and timing of reopening the economy here? And if you look at the two most recent readings, University of Michigan consumer sentiment, it was the worst reading since last August. That's a pretty big disconnect given, where we are at this point in the year. The progress around reopening, the vaccines, still at very early innings, but starting to be deployed. Pretty notable that the consumer, at least by this measure, is not necessarily a believer. If you think back to what was happening last August, we were seeing a pretty significant acceleration in COVID case curves. Things were, getting pretty tight again and locking down going into the fall. So that's a word of caution, I would say, in terms of that sentiment indicator. And I think it's questionable and concerning to some degree about how quickly consumer behavior is likely to revert back to pre-pandemic levels. And then the other one that we look at very closely, NFIB, small business optimism, it did tick up a bit from last month's reading, but net, it's still much closer to the depths of the lockdowns versus where we were at this time last February. So again, by that measure, small businesses still feeling very much under the gun, under a lot of pressure. And I think it's just very reflective of the need for additional stimulus coming into the system until we can bridge this gap to reopening.
Additional stimulus coming into the system, but coming in the right way, coming in from the ground up. Because when you talk about the divergence between Wall Street and Main Street, and it's been going that way, I believe, probably for 2 decades, but it's reached a point now over the course of the past 12 months during the pandemic, which I believe is untenable from the standpoint of pitchforks in the streets, right? And people feeling like they are so out of, so disconnected from this massive influx of capital that we're seeing and this whole frothy environment and markets on all-time highs and people throwing $70 million at a digital JPEG art, right? And all this craziness that we're seeing. And you have a huge part of the economy where people are really having the hardest time they've had in their lives, where people are starving to death and people are, you look at the lines at the food banks, right? And the amount of small businesses that are closing, it's heartbreaking. And, the faith and hope that people have that some of these stimulus programs are going to trickle down. I know, of course, we've got the checks coming now, the $1,400 for everyone ground up, but most of the money that's being spent in the bill is being spent top down, same as it always is. And that always widens the wealth gap. So does zero interest rates. It widens the wealth gap. And I am concerned that we are at a point of no return where there's going to be implications beyond just the economy, but implications in terms of social unrest about, what's happening in the economy.
Well, we've certainly already seen quite a bit of social unrest over the last, 12 plus months. So much of that, I think, is already here. And I think it's very reasonable to expect that to continue in some way, shape, or form. I think the other place where it's showing up is certainly in the retail trading army phenomenon. You're certainly seeing some of that backlash and uproar showing up in that area. And I would just simply say there, this is a deja vu all over again moment. I mean, we first saw it last spring and into early summer with Dave Portnoy and the Barstool Sports kind of phenomenon of getting involved in investing there. It was a very different type of exposure, and it certainly was a very different type of market and economic backdrop then. But is it any surprise that, at the beginning of 2021, we started to see that in the Reddit raiders and the retail trading army kind of give rise to that? Again, I think, with the stimulus checks here in this latest round of programs, wouldn't be at all surprising to see that kind of rear its ugly head again. So that's kind of an interesting, divergence, or a little bit of a new development as it relates to the cycle that we continue to watch very closely. But I wouldn't be surprised to see it again. Not that it has enough power to derail this market rally and the recovery that we've seen, but it certainly is a notable one, and it certainly has led to a pretty significant uptick in volatility for the few months that it ends up being pretty active in the marketplace.
What do you make of this idea that it's all one trade? I've been reading, I think, like 3 or 4 different blogs or people that I follow talked about the same idea in the past week, that, Bitcoin and crypto and the sky high tech valuations and the retail trading and the VC valuations and the NFTs, that it's all like one connected, frothy, FOMO YOLO trade. Like, do you buy into that idea?
Well, I think there certainly is a connection between all of those things. I mean, I'm not sure that, it's necessarily one size fits all. I think a lot of it is born out of the innovation behind, the blockchain technology. And if you think about really the last 10 plus years, I mean, I don't want to make a wild generalization, but we have been in somewhat of an innovation drought. It hasn't been completely non-existent. There certainly have been pockets of innovation in tech and some healthcare breakthroughs, but on balance, that has been noticeably absent, I think, over the prior cycle. And so seeing the blockchain technology, seeing the cryptocurrency kind of revolution come on here with a vengeance, I think there's a real interest and appetite on the part of many market participants for what is that next big thing? What is the next moment of innovation? Just because I love my phone, let me just say as a caveat, I love my iPhone, but just because I get a new phone with a, slightly clearer camera doesn't really change the game in terms of productivity. And so I think there's this real yearning and interest with markets, both equities and fixed income, sitting at such elevated valuation levels for what is that next big thing? How do I get access to, how do I get exposure to that next true creative destruction and rebirth cycle? And I think that's really what's driving a lot of the interest in some of these particular areas. Is it one size fits all? No. Is it connected? I think absolutely. But I think at the heart of it, it's just this quest for true innovation and kind of getting in on the ground floor, because I think a lot of market participants, perhaps the retail investors themselves, feel like they've been left out or left behind as traditional public equity markets have rallied to such great heights. And, when you look at fixed income, I mean, there's not a lot of opportunities in fixed income at this juncture either. It's kind of a really interesting crossroads where we expect pressure on equity returns to be definitely pretty significant, and projected returns to be somewhat subpar, below average over the next 5, 10 plus years. And given where interest rates are pinned, this is effectively the end of a 40-year bull market in fixed income. And so what is an investor to do when you're at this crossroads? I think it's clamoring for that next big thing.
No, I don't disagree. And especially, with traditional investments looking the way they are. I mean, you mentioned fixed income, but in the equity markets, by any measure, equity markets are expensive right now, by any measure. Does that deter you from investing in equities? I mean, where we are in a cycle, they can always go higher, they can always go lower, they can always go higher, right? And I think there's a lot to this Tina idea that there is no alternative. You have to invest in equities because, there is so much cash in the system that's going to, find its way to the equity markets, and because you're not going to get any interest rates, you're not going to get any yield anywhere else. So what do you make of that? And where can you invest if you're scared off by the equity valuations?
Well, it's another great question. There's a ton to unpack in this one. I mean, I think you're absolutely right. It's not a stretch to say that valuations are stretched really across the globe, and that goes for equities, and it certainly goes for fixed income. I mean, if you think about, all the talk about inflation being so scarce, well, it certainly shows up in asset price inflation. And so we've really seen that in terms of valuation multiple expansion. If you look at the S&P 500, if you look at the MSCI Emerging Markets Index, if you look at the Russell 2000, they're all at least 40% above their respective 10-year forward PE averages. So definitely elevated by that measure. But I think I always come back to this idea that valuations are very much a relative game. And so it's important to frame valuations not only relative to other asset classes, but also what's happening in the macro landscape. And so if equities seem expensive, and we think they are, I mean, it's hard to say that they're not expensive. We don't think that they're in bubble territory, again, given what's going on in the macro backdrop. But fixed income is a very different story. And so if you look at investment grade bonds, yield to duration ratio is at an all-time high. And it's also hard to say that the yield for high yield bonds reached an all-time low in mid-February, 3.9%. Even with the backup in rates, it's still not really a very high yield, right? Pun intended there. And so it's absolutely what happens when interest rates are pinned at low levels. And we just continue to see this unprecedented amount of monetary policy accommodation coming into the system. In fixed income, you have to be really careful, and you have to pick and choose your spots very, very carefully at this point going forward. We do think there are pockets of opportunity in the below investment grade asset classes, but this is not a back up the truck kind of story. I want to put all kinds of disclaimers around this one, that you really have to talk to the advisor, whoever you're working with in terms of portfolio guidance, to see what makes sense in your holistic kind of portfolio solution. But we do think there are pockets of opportunity in leveraged loans, in high yield, and even emerging market debt to a degree. We would not be recommending backing up the truck in purely passive vehicles that would access these types of exposures. We think just given the backdrop and given the still significant uncertainty, we think there's a lot of value to be had in the credit analysis component of it. And so actively managed strategies and below investment grade fixed income, we think can add value given where we are at this point in the interest rate cycle. On the equity side, we think we have more options to choose from. So we really do think that one of the most attractive areas is emerging markets. I know that can be a little controversial, but we actually think we're in the very early innings of this baton handoff from the developed world to the emerging world. These cycles happen in very long periods of time, 10 plus years. And so we think we might be at the crossroads for that baton handoff. If you look at emerging markets in particular, and you can believe, the data that they have shared around the pandemic and COVID case curves, et cetera, on a relative basis, versus the developed world, they have managed through it better. And so what that means is it has enabled them to get their economies more open, not fully reopened, but certainly more reopened than much of the developed world. And so from an economic growth standpoint and an earnings growth standpoint, they didn't fall anywhere near as far in 2020. And yet some of the strongest, brightest growth prospects in 2021 and beyond. And so we really think the fundamental story there is actually very strong. Yes, valuations are elevated, but on a relative basis, we think valuations favor EM over the developed world. They certainly have a number of additional policy levers to pull if they start to get into, not that we think we'll see that necessarily in terms of a double dip or challenges around the pandemic lingering, but they have a number of policy levers left to pull where not necessarily the case so much in the developed world. And then from a yield perspective, surprisingly attractive pickup in yield. Other areas that we like in equities are, the NASDAQ 100, That can be a controversial call. I know it's still very much the stay-at-home trade, but we think when you adjust for the fundamental growth prospects of much of the NASDAQ 100, it's really not as expensive as what, traditional just 4P might lead you to believe. And so they have been able to use the pandemic to their advantage to some degree and have really pulled away from the pack. And you saw it play out very clearly in Q4 earnings results, really, really strong out of many of the key constituents there. And so we think that they're going to continue to power forward. And this reset here certainly would be a buying opportunity in our view. We also like global infrastructure. And this may sound like a bit of a departure from the two that I just shared with you that tend to be like really growthy and turbocharged growth. But we do think we'll continue to be in a very high volatility regime for quite some time. Not record-breaking volatility like what we saw in much of 2020, but we do think, just given the path forward, likely to continue to be pretty volatile. And so we like the characteristics of global infrastructure because it helps keep investors effectively invested in equities. It's a smoother ride, less cyclical exposures. It really injects some nice ballast into the middle of a multi-asset class portfolio. So quasi fixed income like characteristics, but also some equity like characteristics as well, and a very attractive yield pickup. At the end of the day, this is a long-winded way of saying anything that has high quality and sustainable growth, and anything that has high quality and sustainable growing yield wins. That's the backdrop we think makes sense going forward. We're going to continue to be in a growth and yield starved world beyond 2021. And so those are the areas that we would be really focused on in terms of allocating in client portfolios.
Makes sense. All right. That was great. I really appreciate that. Amanda, I like to close with this question, which is tell me about an obstacle that you've had either in your personal life or in your career that you either found a way to work around or that you just persisted straight through.
Well, this is going to be a really lame answer, but I really have not had a ton of obstacles in my career that have felt insurmountable. I have been really blessed. I've had a lot of folks that have been willing to recognize my work ethic and really open doors for me at various kind of pivotal moments in my career. And so I'm eternally grateful for all of those opportunities. And, there hasn't been one defining obstacle that has stood, in my way in terms of progress and opportunity. And we all have challenges, right? There's always small things that get in the way. Like one for me, this is a small thing, but it still is something that I wrestle with today is public speaking. Back in the day, I'd be paralyzed by, having to do anything public speaking related. And now all I do is talk all day long in all different channels. But, you learn to overcome these things by doing. And I think my work ethic has helped me to kind of overcome that personal challenge of my own. But net, I just have to go back to this idea of really recognizing that I have been truly blessed and I have been so lucky and fortunate, especially on a relative basis versus, all of the eye-opening events that have occurred over the last, 12 plus months. I'm just very, very lucky and very, very grateful.
It has been an insane year. We're certainly never going to see anything like it. But, congratulations on the recent promotion and the fact that you've been able to thrive during that year. And I got to say from this podcast alone that you have kicked any fear or hesitation that you've had in public speaking. So congratulations on all that. Thank you for joining us on the podcast. What is the best way for people to follow your research going forward?
You can follow our we don't publish all of it, but we do publish a number of things on the PNC investments page, pnc.com. You can check it out there. We also put things out under my Twitter handle at Amanda Agati PNC.
Great. All right. Well, thank you for joining me. Thank you for joining the show. Thank you to our listeners for your time and attention and for your reviews. Those of you who did, I thank you for that. And we'll be back with a new show next week.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.